Non-QM loans aren't risky, but they're a trap for entrepreneurs who don't know the game. The real risk is not being fully educated on exactly what's available in the non-QM space and how these loans work. If you don't pick the right lending team to work with, you're going to end up paying more in interest, paying more in fees, and putting more money down on the house than you ever had to. I'm Andrew Russell, owner and founder of RCG Mortgage, top originator across the country via Scotsman Guide, three-peat winner of Broker of the Year, and I specialize in working with entrepreneurs, business owners, and investors on putting them in the right non-QM mortgage and always getting them the best deal. So I do a lot of videos on social media around DSCR mortgages and non-QM mortgages. And I did one about a DSCR, debt service coverage ratio, the best loan for investors. And a client actually DM'd me and said, hey, I'm just curious. I have this weird feeling on this mortgage I'm getting through this, local bank. Can you just do me a favor? Can you take a peek at, what kind of deal I'm getting and just tell me if you feel this is something I should close on? We're supposed to close in a couple weeks. I just have this weird feeling. So I said, sure. So I DM'd him my email address, ended up emailing me the rate lock information. Really, let's just call it the fee worksheet or a loan estimate or whatever documentation he had. He forwarded it all to me, and we took a peek at it. And it turns out that he was actually getting a really bad deal. And he was getting a bad deal because he wasn't educated on a DSCR mortgage and some of the riskier features or some of the things where if he was educated, he would have known to ask, and maybe that wouldn't have been the right lender for him, which it wasn't. He was definitely using the wrong lender. So the first thing was he was actually putting 35% as a down payment, and he was worried about his own liquidity. He wanted to keep money. He didn't want to put a third down on the purchase. He wanted to keep money for renovations and potentially a future investment purchase. So I said, hey, why aren't you putting 20% down? 20% has really been the minimum for DSCR. You can do a little bit less sometimes, but 20% has the best pricing, even 25%. But 20% was a great number for him. So I asked why. He said, well, they didn't even offer that. They just said 35% is the minimum, which it isn't. So I said, all right, that's the first thing. You could definitely, and my understanding was, I think it was an $800,000 purchase. So, saving 15% out of pocket, you're talking $120,000 of cash for an extra, $700-800 a month. For him, it was a no-brainer. So that was the first thing. Second thing was he didn't realize there was a prepayment penalty of 5 years. So what's a prepayment penalty? It sounds exotic, and it's really nothing, similar to the days of the crash, which is more adjustable rate mortgages. He was still getting a 30-year fixed rate mortgage. A prepayment penalty, it's when if you pay off the mortgage or chunk it down over a certain amount, or even sell your house, which again would pay off your mortgage, you have to pay a penalty based on what you borrowed. So if he borrowed $500,000, typically a prepayment penalty is about 5% of the balance, which is $25,000. He would have had to have paid. His intention was, in fact, he was going to rent it, but he was most likely going to sell it within 3 years. For him, a 5-year prepayment penalty meant if he were to sell it, he would lose $25,000 of the equity because that would be tacked on to the payoff. So the second, piece first was, of course, he's putting too much down. Second was there was a prepayment penalty, which he didn't even know what that was, and he didn't realize he was going to lose $25,000 in the future. And the third was the rate and fees. The rate was very high versus market, comparatively even to a 20% down purchase, but more so the fees. There was 3% in origination fees. So his loan was, say, if it was $500,000, there was a $15,000 straight up bank fee that was just a fee, and it wasn't needed. So it turns out, apples to apples, he had an $800,000 sale price, putting 35% down with a 5-year prepay and $15,000 in fees, and I was able to quote him, and eventually he moved his business over to us, and we were able to close on time and get him a way better deal. I saved him $120,000 out of pocket in terms of down payment, number one. Number two, we lowered that 5-year prepayment penalty down to a 2-year because he was sure that he was only going to keep it for about 3 years. So I hedged. I gave him, a year of cushion. So we did a 2-year prepayment penalty and still beat the interest rate he was being offered. And 3, we were able to bring the points down from 3%, which was, $15,000 when he raised the loan amount. Our loan was a little bit higher, but we saved them about $10,000 in points. We saved them $120,000 in out of pocket. We saved him 3 years from a prepayment penalty. There is a point to taking a prepayment penalty. It gives you a little bit better of an interest rate at times. We brought a 5-year down to a 2-year, got him a better deal. And we saved him $10,000 in just straight up burned cash that was going right to the bank. It's better off in his pocket. So, of course, I hear everyone saying, Andrew, I'm not even self-employed. Your videos, they're thebomb.com, but, I'm not self-employed. How does this relate to me? It's not just if you're self-employed. There's all sorts of different mechanisms and modes for non-QM loans, and even specifically a DSCR mortgage. so many social media videos where all the gurus are like, hey, it's time to be an investor. So if it's time to be an investor and buy properties, residential, 1 to 4 family, maybe even 5+ unit properties, the DSCR mortgage is for you. So you don't be necessarily self-employed. You could be a teacher, you could be a fireman, you could be a police officer. You could be in the Army, Navy, or the Marines. You can be whatever you want to do for a living. But if you're going to be an investor, this mortgage is for you, and you need education on it. And of course, the other piece is always, hey, Andrew, if I speak to a loan officer at a bank or a credit union, I have to trust them, right? Like, you guys are licensed. So the answer is yes. We are very, very regulated, and we have a lot of people making sure we're doing the right thing. They check our credit. We can't be bad humans in the world. Absolutely. He or she that controls the money has to be, hopefully moral and ethical. That's the goal. But sometimes loan officers are only as good as the place that they work. So there was nothing wrong with the loan officer that client, which we were referencing, was working with. There's nothing wrong. Like, that's the product that bank offered. They didn't realize that if they worked at a broker company, so you have to work with mortgage brokers because we are on board with all the lenders. We're not stuck with one specific bank and what products they offer. We can offer the full product suite, what's available in the industry, in the marketplace. So although the loan officer might be trustworthy and great at what they do, they're probably working at the wrong company, because if they worked at a broker company, would have known you don't have to put 35% down. You don't have to always get a 5-year prepayment penalty on a DSCR mortgage. You don't have to charge all these crazy fees because the bank tells you. There are other banks that have better pricing, which you then can pass through to the consumer. So it's nothing against the loan officer specifically, but just make sure, number one, the loan officer has credibility, Google reviews, all that good stuff. But number two, they're working at the right company, which is a mortgage broker company. All right, guys, I'm going to go over right now 3 ways, that's right, 3 specific things for you to educate yourself on through this video, to learn about. And if you're going to get into the non-QM space as a buyer, you will at least be fully educated and aware and have transparency in what to look out for. So if these things pop up, at least you know, hey, first thing is going to be rate and fees, what to look out for rates, fees, what's common and customary, and where you're getting kind of ripped off. The second piece is prepayment penalty. What is it? Why would I ever want it? If it's there, should I keep it? Am I getting ripped off again? And the third piece is your down payment. Not all lenders are the same when it comes to non-QM financing, both on primary or investment properties with DSCR. Some require more. Doesn't mean that that's the universal standard for down payment. So what to look out for and what's common and customary. Before I get into it, make sure, guys, you go in the description, click the link, our non-QM buying guide. Our team spent so much time on this buying guide, and it's free, guys. So make sure you go in the description, click the link, and get our non-QM buying guide. It's the T. All right, so the first thing is rate and fees. So rate and fees are very important because the 30-year fixed rate mortgage, mortgages right now across the country are going up. Why? Because values seem to be going up. So for every quarter, 0.5% in rate, maybe even 1% in interest rate on a 30-year fix, could be $100, $200, maybe even more. But it doesn't sound like all that much. An extra $160 a month. I mean, it's a lot of money, but it's not. Is it going to change your life? That's $2,000 a year. 2,000 times 30 years, if you stay in it for 30 years, that's how much, guys? $60,000. It's a lot of money. You can do a lot of really cool things with $60,000. So the rate is very important. The fee side, so there's something called origination fees. Now, people shop around all the time, and they shop around the wrong things. You always should shop around the rate and the origination side. What does origination fees mean? It could be application fee, processing fee, underwriting fee, commitment fee, discount points, broker fees, just points in general. It's anything that the lender, the bank, or whomever is charging. So there are typical fees because, yes, guys, newsflash, we as mortgage professionals, I just had this conversation yesterday, actually, with our referral partner. We are giving clients something for $1.02 that we're getting for $1. Now, it's all about the margin. Everyone's margin is different. There's broker margins, there's banks, there's credit unions, there's mortgage banks. But the fact of the matter is, in a sales position, we're leveraging something we get for one price for a little bit more, and that built-in margin is how we make money, a very fair number. And that's just how it is right now in economics. So unfortunately, some people's margins or fees are a lot higher, and it's kind of not warranted. So it's just something to be cognizant of, specifically the fee section. So yes, do lenders have processors, need processing fees, underwriting fees, commitment fees, application fees? Sure, it has to be nominal. Usually it's between $1,000 and $2,000, and even at that, that's really been the ceiling. It just has to do with the points. Points are 1% of the loan. So sometimes people, as an industry standard, they charge a point, 2, 3 points of the loan size. That's how they make money. So that's something to always be cognizant of. Definitely pay attention to, only because if you go from lender to lender, some places might charge no points. Some places might charge 1, which is fair, 1% of the loan. Some places might charge 3 or maybe even more, a mixture of origination fees and discount points. So it's just something to be cognizant of. So specifically in the DSCR mortgage, the debt service coverage ratio mortgage, there's a huge disparity of points, fees and interest rate as you go from loan officer to loan officer. So as a story, I once had a client and they were purchasing a really cool 4-unit property in Miami. I didn't even know Miami has 4-unit properties. At this point, I just think it's condos on the water and it's just yacht parties. But somewhere in Miami, which is ginormous, us New Yorkers didn't even realize how big Miami is, there was a 4-unit property. He's getting a sweetheart deal. But again, he thought that he was getting a raw deal. So it turns out that he knew one of my past clients. It was some kind of a network event. He brought it up, hey, I'm going to close on this 4-unit property. And one of my past clients, like, hey, you got to reach out to Andrew and his team. Just get a rate quote. It's free. There's no real reason not to. He saved me on my purchase. So the client reached out. So it turns out that he was using a broker company, which is similar to us, broker company. So normally you would think they get a great deal. But you're only as good as, broker company-wise, the lenders that you work with. So there are some lenders that we work with in the non-QM lending space that are fantastic, great pricing, great rates, and some that are not. So just because you work at a broker company doesn't mean that you're on with the right lenders. So there's a lot that goes into it, as you can see, which is why we earn our keep. So this client reached out to us, and we saw they were getting some form of a rate. I think the rate was believe it or not, 8.25%, and they were paying 3% in fees. So for whatever reason, this broker company decided on this DSCR mortgage to align them with a lender, and it was very vanilla, even at a rate of 8%. If you think of, let's call it $1 million property, just to give you an example, $1 million property, 20% down, it's an $800,000 mortgage, roughly, very rough. It's around $5,600 for the mortgage at a rate around 7%, just loose. Say the all-in payment's $7,000, including taxes and insurance. On a 4-unit property, if you have 4 market rents at $2,500 a month, times that by 4, that's $10,000. It more than covers. So this is a cake deal, sweetheart deal. It's an amazing purchase for the guy, but he deserves a great deal, right? And he was getting somewhat ripped off. So we just price checked and saw that 8.25% should have actually been 7%. That's right. So 1.25% difference just in rate. And that 3% in fees, the fair market cost or price of those fees should have been 1% with us. So we were able to, he just converted his application to us. We were able to get a better deal. We were partnered with better lenders who offer better programs. We go direct to the source. Some of these other lenders, even if you send it to them on the broker side, the loan closes with them and then they have to send it to another company. So there's a lot of middle people. We eliminated the middle person, went direct to the end lender source with the best pricing, and saved this client 1.25% in rate, which is absurd, and about 2% in fees. So we ended up saving them about $16,000 of just cash, and we saved them hundreds of dollars a month in interest every month for a year, for 30 years, just by using our services. So as you can see, who you work with makes a huge difference, but rate and fees is definitely something people don't realize. They feel like, oh, I knew this. I think he actually did know the loan officers, either a family friend or whatever it was. You always want another opinion, especially if you're getting that heebie-jeebie feeling. But rate and fees are definitely something to be cognizant of, only because the difference in rate and fees, just a lot of money, can be put to use in so many better places. Now, the second thing specifically is a prepayment penalty. So a prepayment penalty is if you pay off the loan. Let's use a 5% example. Typical prepayment penalties are 5% of the loan amount. If you're getting a $500,000 loan, 1% of that is $5,000. So if you have a prepayment penalty for a year, if you pay it off in the first year, you're paying 5% in additional fees of whatever you owe on top of the loan balance. Say at the time you owed $500, your full loan balance, you're gonna have to pay out $525. If you get a prepayment penalty for 2 years, usually there are 0, which is none, 1, 2, 3, 4, 5. Right? So you can go all the way up to 5 years. If you pay off this loan within 5 years, you're paying an additional $25,000. Now, why would you ever do that, Andrew? Let's just do a no prepayment penalty option. You would only do that because as you go down in prepayment penalty, the interest rate or closing cost goes up a little bit. And of course, it's specific to the lender. Each lender could be a little bit different, but as you go up in prepayment penalty, the pricing gets a little bit better. So take, for instance, the client we spoke about before. That client was definitely going to get rid of this property that he was purchasing the investment in around 3 years, but he got a 5-year prepayment penalty. So the lender that he was working with, if you remember, it was just 5-year prepayment penalty. So we work with lenders that allow all the way down to 0 years. But it's it's kind of like a seesaw act, right? I remember my kids, seesaw. So it's like as you go down in prepayment penalty, you go up in rate or fees. So we found the perfect kind of harmony and middle ground with the best lender for them. So if you remember, we brought down that prepayment penalty from 5 to 2 years, and we still were able to honor an outstanding interest rate. So a prepayment penalty, it's not the end of the world. You have to see if it's right for you, but you have to be 100% certain that you're not going to either sell that property or pay it off early, only because if you do, there's going to be that fee, and no one likes, if you're selling your house for $800,000 and you owe $500, you're going to net $300,000, right? And then you're like, well, wait, it's 300 minus 25, so 275. Where'd the other 25 go? Oh, I had a prepayment penalty. I lost 25 grand. No one likes last minute surprises. So just make sure on these DSCR loans and the ones that have prepayment penalties, which is very popular in non-QM space, you know what you're getting into. And if the prepayment penalty is there, that it has to make sense for you, and always be conservative. And of course, the last is the down payment sizing. So typically, in non-QM and DSCRs and bank statement programs, when these programs came out hot a few years back, it was 20, 25% down or more. Just because that's what it started doesn't mean that's where it's at today. Now, again, some people don't realize they reach out to one person and they're friendly with them as a loan officer, and they trust them, and they say, hey, listen, you have to put down 25% for this program. Why? You're not showing your income. You're not doing conventional mortgage. This is just what it is. It is what it is, right? Some buyers believe that. But we had an example of a client, a self-employed business owner who actually worked in the Diamond District. Amazing guy. He was the guy that you call for the watch that no one can get. It always seems to be off a truck, but he actually got legit watches. He's a super cool guy. He's buying an amazing house, but he didn't want to put down 25%. So he ended up, his realtor was like, look, let's get a second opinion. Speak to Andrew. He specializes in non-QM. And I spoke with this client, and it turns out he actually could put down 15% instead of 25%. That doesn't sound like a huge difference. But when you're buying a $2 million property, what's the difference of 10%, guys? $200,000? It's a big, big, big difference. So as was the case with this gentleman, if he just would have went with the first opinion, and I mean, again, his spider sense, something was wrong with the situation, which is why he asked for a referral. So not all lenders are the same either on down payment sizing. Some are cool with, even on bank statement programs, depending on the sale price, 10% down. Now, some of the states, there's some state variables in there. Some of the states have more regulations than the others, but you can get away with a 10% down payment on some of these non-QM loans on a primary purchase. Of course, what's the con? You're like, hey, Andrew, that sounds amazing. What's the con? The con is, of course, the rate. The rate starts to become so much higher. Sometimes, to me, it always makes sense to put down 20% because I do 15, let alone 10. The rate goes so much higher, it becomes a little bit of a ripoff, in my opinion. But sometimes a lot of misinformation. Again, this whole point of this video is education. The loan officers that you speak with, sometimes they're not giving you the right information, and there are other options. And in this case, down payment. Make sure you educate yourself on the type of mortgage you're getting in the non-QM space and the down payment. Because if you're putting down 35% in the case of some of these DSCRs we talked about, or 25% for a primary purchase, you might be able to put down less and get the same or better interest rate with lower fees. You just have to know. All right, guys, before you consider a non-QM loan, make sure you watch our next video. Every single non-QM loan explained. It's going to go over all the different non-QM loans, what the differences are. It's going to show you very clear how you differentiate between all of them, between occupancy and documentation type, and first-time investor, first-time buyer. So make sure you click this link, watch our next video to learn all about non-QM loans.